as we celebrate 3 years of disciplined investing with our VRDDHI PMS. Markets throw new opportunities and challenges every cycle. Having a time-tested investment philosophy during this time can help you navigate these uncharted waters. That is why we welcome you to join us this Saturday, our fund managers of VRDDHI, Mr. Rajat and Mr. Rohit, from 10 a.m. to 11 a.m. as we tell you a lot more on VRDDHI's disciplined approach to investing during the ongoing bull run. For the second webinar of the day, we talk more on setting the right milestone. This will take you through things like how to set your goals, distinguishing between short-term and long-term goals, things like investments and savings instruments that you use to achieve these goals, as well as how to look at asset allocation. This webinar will be from 11 a.m. to 12 p.m. Are you someone who's worried about the differences between the old tax regime and the new tax regime? Join us for the upcoming comprehensive tax planning webinar from 12 p.m. to 1 p.m. where we talk a lot more on tax planning, how to do better tax planning, and how to do it more efficiently. For the final webinar of the day, we talk a lot more on 401k portfolios, how to review them and rebalance them in your retirement portfolio. This webinar is from 7:30 p.m. IST.
Why this problem goes far beyond front running. Let me give a clear warning. This video is all about quant mutual fund. I'm making it very, very clear. But I also want to make it clear that this video has nothing to say about the philosophy of the individual who has built this company or its success. This video is all about how this affects an ordinary mutual fund investor. I'm going back to an episode in another mutual fund, and that is the starting point of the discussion. I'm going to talk to you about what happened in the debt mutual funds of Franklin Templeton Mutual Fund. A lot of you felt that there was something wrong in what the fund or its managers did at that time. I hold a completely different view. Certain managers have a style which does not suit the mutual fund format. They are better suited to the hedge fund format where they don't need to make disclosures, they don't need to give liquidity, and they enjoy a lot more freedom, which is insular in nature and helps them deliver performance. In my opinion, the model of the Franklin Templeton debt management in that period by that manager was better suited for a hedge fund format or an AIF format. It was ill suited for retail mutual fund industry. The risk management, the investor profile, the investment horizon, the liquidity were all mismatched. When all these things are mismatched, you're setting yourself up for trouble on some day. And on a bad day, the trouble can hit anyone. And that is exactly what happened in Franklin Templeton Mutual Fund. I hold that view with the deepest conviction that the investment model of quant mutual fund is not suited for the mutual fund format. It is not suited for the mutual fund format because such an investment model cannot be done in the open way in which mutual funds have to function as per regulatory requirement. If you are going to have an investment philosophy where you say that you will only buy businesses which are doing better, whose stock prices keep rising, and that you will exit businesses whose stock prices are going down, and that your model is actually worked around several principles of momentum investing, it effectively means that what you will do is probably well known to a lot of people. It's not difficult to second guess what you will do. Let me explain. Assume that you do a bulk deal in a small cap company And there have been several bulk deals through which these mutual funds have to invest, and Quant is no exception. When you do the bulk deal, it's an announcement that you will continue to buy this company as long as it does well. So, anyone, it could be brokers of Quant, it could be any of you, can start tracking that company, buying some shares with the clear intent that you will sell it to the mutual fund later as the company keeps continuing to perform and the stock price rises. Now that clearly, by definition, is front running. And who is giving you this information? The fund house itself is giving you this information as per the standard norms of the mutual fund industry through disclosures which are monthly in nature, through a fact sheet, through disclosures which are related to stock exchanges when they cross 0.5%, through disclosures mandated in private placements, in bulk block deals. So the information that can easily abet front running by anybody is being provided to you, and it's open to any of you to try that. So as this fund house keeps growing in size, more information is going to be available because the transactions are going to become larger and more disclosures will be warranted and more disclosures will be in the public domain and more people will be aware of this. This essentially will open the doors for extensive front running. And the fund house will also go into companies which it likes fundamentally, which it likes as per its own momentum model, which it believes will start doing well where there is liquidity, because a 90,000 crore fund has to look for liquidity. So they are going to look at liquidity all the time, and they have been. As they look for liquidity, they will become the elephant in the room in every single company where they find the liquidity. And I will leave it to you to do your homework and understand why the fund house is almost the single investor, the solitary one in several small cap companies. Now, once they buy, and it is public information, they are brokers, they are unit holders, large proprietary high net worth individuals, or just about anybody can front run to them, because they are going to keep receiving money in these funds. As the NAV keeps going up, they are going to need to invest this money. And as they keep receiving more funds, they need to invest the funds in the same stock. So everybody knows what's the option. Because you have made a disclosure that you have bought a bulk or block deal, you're not going to stop buying the stock as the company keeps performing. That's the philosophy. Which is why this model in the mutual fund space will always present a structural risk. It is more suited for the AIF or the hedge fund space. That's my view. Now, I'm not going into the merit of what happened in this episode because I have no information, and it is for formal communication from the concerned authority to educate all of us. So, I am not going to speculate on any of this, but the purpose of this video is to tell you clearly that this model is not ideally suited for the mutual fund industry and will always be vulnerable to front running. Now, when a model is going to be vulnerable, it is always going to make the investors vulnerable at some point in time. I am not grudging the success to this day. I have no view on that, because sometimes some models work very, very well in a market context. But when the market context changes, we don't know what will happen to the model. And as an investor, as a market participant, that is something that I always have concern for. I had it with Franklin Templeton's debt investing as well, and I continue to have this in Quant's equity investing as well. And my view is not a criticism of the fund manager or any person related to the fund. I am talking about the merit of the model and its vulnerability. As an investor, you need to recognize this vulnerability and understand whether you want to be vulnerable to this kind of a model. And that's an informed choice that every one of you will make. I don't wish to influence that choice. I don't want to offer an opinion, but I personally will choose a model which has less vulnerability. Thank you for watching this video.